Hi, everyone. Welcome to the TimingResearch.com Analyze Your Trade, episode number 112 for February 11th, 2020. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today we will be discussing your trade ideas. So over the last few days, about 30 people submitted up to 5 symbols each, and I've put the list of top requests together, and we're going to get through as many of those as we can today. So we are recording this at 4 p.m. Eastern Time. And this will be available if you subscribe to Timing Research on YouTube or your favorite podcast directory, or you can also get all the recordings on TimingResearch.com. So today I have just Jim Kenney here to do a solo show of his thoughts about the symbols. And I'm going to go ahead and turn it over to Jim.
Okay, great, everybody. Good to be with you. And again, we've got 15 stocks, all very interesting, different sectors in a lot of cases, so a wide diversity. Just a quick overview here. As you can see from the screen, the stock market did roll over at the end of the day. You know, not too surprising because we had such a big run. And also Tuesday sometimes is Turnaround Tuesday, and that's definitely people who played it that way from the morning were very happy when they went home because, as you can see from the screen here, Dow Jones was way above 29,400, and then bam, went all the way down to 29,200 almost. And then, of course, the NASDAQ as well, all the way down to 96.20 by the end of the day. So people who played for Turnaround Tuesday, they went home with some money, that's for sure. Okay, I'm going to give you my opinions and my observations on these stocks, and then about midway through, I'll throw a few out that I'm watching and see what you guys think of that as well. Let's start out with the first symbol, which is CGC. And CGC is cannabis, so it's marijuana. So you know it's been tanking and been tanking pretty good, going from $52 in the last 52 weeks on the high down to as low as under $14. And now it's bounced back up to 1988. I guess everyone is wondering, is there a turn going on here? And let's see if the technicals give us any idea. With regards to the volume, you know, huge volume pop there, so that's not bad. Another high volume pop there, and then the volume dies out during the drop. So as far as the volume is concerned, the pops seem to have had better volume than the declines. That's not a bad thing if you want to be bullish. And let's give you, it's up today 4.5% almost, so certainly it had legs today, but it is coming off of the floor pretty well. So let's look at under the hood here and see what the moving averages are telling us in the volume. Okay, this is a company that's losing money, so obviously it has no earnings, and it has a market cap of about 6.6 billion. So it's got a pretty big market cap, and it trades 8 million shares here today, which is about even with what it's been doing for the last 50 days, and it's actually an increase over the volume in the last 200-day average. So last 200-day average was 6 million, and we're at 8 million. So interest is increasing here. Now, you did hit the low of 1381 back in November when a lot of things bottomed out. And like many stocks, it had a bit of a run up towards, I guess, around 20 or so, or a little bit higher. And then it pulled back again. And where are the moving averages at? Well, here you're at 20, let's call it 20 even just for the sake of rounding, and 28 on the 200-day. So the 50 days underneath the 200-day, and they're both pointing down. So could this have a contrary move up because it's in an oversold condition? Well, you know, when we went down to, 13, 14, and say the 200-day might have been at, say, 30, to give you an idea, that is a differential of about 14 points. So it's about 100% underneath its 200-day average when it goes down to 14, right? So that is something that's called oversold, and it sometimes can try to go back towards the mean. And that's basically what it did. Now, let's take a look here at the chart again. Let me push that up here for you. Okay. There you go. Now, let's take a look at the chart. Like I say, we popped out here down to 14, and the moving averages are way up in the 30 area. So what does it do? It has a try to close the gap between where the averages are and where the price was, very oversold, and it did that, but now it's resumed its downtrend. Now, over here around 30 would be resistance because there's some stuff going on there. And of course, it couldn't get above 30 here. And then the recent highs around 26 or so. But right now, getting above this 22 area right here would be very constructive. And of course, getting above 25 would be very constructive. Again, you are buying something that has lots of people that have gotten out. So sometimes when everyone's gotten out and the news change, you can pop it back up. But it's in the downtrend. It's got plenty of resistance above. And if you're trying to do bargain hunting, then obviously you'd try to find a line in the sand. This 15 number where there's a gap would be a line in the sand that you could use, 15. And then, of course, if it got above 25, then the momentum may very well be turning to the upside. So in my view, it could be a better buy at above 25 and above 30 than it is now, if in fact it's never going to be able to break that downtrend. It's an industry, obviously, with a lot of bells and whistles going on and a lot of people with different opinions on every side. But clearly, the people who ran into the pot stocks thinking they were going to make a fortune, they are running out with not a whole lot of money in their wallet. So that's basically what Canopy looks like right now. Cheap because it is what? Gone down in price. Still doesn't look like it's making money according to what I'm reading. And again, the moving averages are prominently market pointing down. Now the 50-day around 20, that's a number as well. You start popping above the low, the 20 mark, at least you're above the 50-day, right? And then of course above 28 would get you above the 200-day. So, monitor it down here. If you want to spec, that's what you're doing down here. And that's about all you can say about Canopy. All right, Apple. Everybody knows Apple. And we also know it's gone through the roof. And we also know that a lot of their supply chain is shaky because of the China situation and the virus, right? So that's why their forecast for this first quarter earnings is very wide, because they don't know exactly how much of an effect it will be. And again, this stock clearly has gone through the roof ever since it broke above 220. So let's pop this up here a little bit and get you a little bit more action here. Yeah. So anyway, last year you're trugging along between 160, 220, 160, 220, and then the horse left the barn above 220. That's where you should have been loading the wagon if you're trading this company, and then putting your stop underneath, say 200. So you have a 10% risk on it, and then basically you'd get all that gain. It hasn't really taken out much of a monthly low ever since. So if you put your stop underneath the monthly lows, at least you're trailing it with something. Or if you want to put a put option underneath the monthly low. Right now, it looks like 300 is a very important number. This thing blows out 300, and then, of course, that'll set the stage for a more significant drop. What would make this company have a significant drop? Well, again, if they can't produce the stuff to sell, they can't make the revenues, right? So that's one thing right off the bat. And then, of course, there was a slowing down, I believe, on their web services and their services numbers. Again, it was still increasing, but the pace of increase did not seem as robust, I believe. Not 100%, but I think. So those are two things. The supply chain getting goofed up, and maybe the stock is a little bit of ahead of itself basis the earnings. 25 to 1 P ratio, people, I don't think that's extremely cheap. It used to be 15 a long time. Then they started putting in the fact that there's a lot of service revenue coming in. So they revalued it at a higher P ratio. Again, real wild card with their supply chain and how China, of course, they sell a lot to people in China. Now, granted, people can still buy things online over there. So, it's still an unknown how much this is going to hurt. Some people, I think Ray Dalio was in there saying that he thinks there's a overreaction to how much of an effect the virus will have. So we'll see how accurate that statement is. Let's look behind the hood on this thing so you can get an idea of what the technicals look like here. This is a company, obviously $1 trillion, going to be $1.5 trillion before you know it. And it's got short interest of hardly anybody because it's blown out everybody probably on the shorts. And then it has gone from 169 on February, Valentine's Day a year ago, all the way up to 327, which was at the end of last month. This month, we have not been taking out that high, so I don't know if that's a sign of exhaustion. It could be. And if you wanted to take strategies that would be sideways or lower on the stock, you have established at least a very temporary high point at 327. Obviously not very tested because it's only been a couple of weeks since it happened, but it is a number that it has failed to take out. Now, here's the key, is the moving average, which has been really accelerating, because I remember looking at this moving average around 200 not that long ago. So it's at 233. What you can do here is you can take a look at where the stock is trading, which is around 320, and take away from it the 200-day moving average, which is 233, and you get a number of 87. If you divide that into where we're at, which is the 320 number, you'll see it's almost 30% above its 200-day moving average. Now, my feeling on this is not always, but quite often you could see a filling of the gap, a reverting back to the mean kind of concept. Again, if they come out with bad numbers and the virus affects their supply chain and web services revenues are not as robust, these are three factors that could come into play. And of course, everyone's betting big on this 5G. That's another thing that's it could be big, and maybe it won't be quite as big. You don't know. But at any rate, yeah, there you're looking at it right now. So what would my opinion be? My opinion would be that it is still very overbought. It seems like it has stalled out at 327, and the longer it stays under 327, the higher the odds are that we're going to go at least sideways. And then, of course, if we break 300, it would open the door for a correction down towards 290, where the 50-day average is, or 233, 240, where the 200-day is. I note today volume was only 20 million shares. You see that right there? And it normally trades 30 million lately. So that's a pretty big drop in interest here today. And so we'll have to see if the next time you see big volume, is it going to be taking out 330 or is it going to be taking out 300? Keep an eye on the volume. It is drying up a little bit up here, which means that, you know, there's less people interested in trading the stock up at these higher levels. If we started breaking underneath 310, 300, you could see the volume pick up, but it could pick up to the sell side. Again, though, that 327 number is not very, shall we say, tested or very mature. It's only a couple of weeks old, so you can't put too much emphasis on it, but it is a point where the market has failed. Again, we'll have to see how the virus affects this company, because obviously this is the one that people are looking at quite a bit. All right, in the semiconductor area, let's look at the index first, the semiconductor index. And let me get that up here for you. Yeah, the semis, again, going up, and is it making a double top up here at 151 area? We'll find out. We know right now you've created a very important point just under 140. So if this thing fails to take out this 150 and then blows out this area down here, again, that could be setting up the semis for a correction. But again, you can't fight the tape, and this thing gapped up, pulled back, gapped up, and let's see if there's going to be a blowout through 150. But again, we're in a neighborhood where if it does fail from here, that would be a double top. And if it takes out this point here, to me, that would indicate that a more serious correction could be in line. Now, again, let's take a look at what the detailed quote's going to tell us about AMD, which is the stock that is listed here. This stock trades ridiculous volume. 72 million shares today. That's what, 3.5 times Microsoft, just to give you an idea. Anyway, you're at 53.78, and it's blowing out to the upside. So the semiconductor index has not blown out to the upside, but this particular stock has. So again, will the semi index follow suit? It very well may. This thing peaked out today at 54.48, and then it went home at 53.78, up almost 3%. The P ratio, I don't know if that's accurate, but it's showing a ridiculously high valuation here. So I don't know if that's accurate, but 181 P ratio would tell me that people are buying this thing on future earnings projections and not on what the current situation is. And when you buy the future, it can be very, very good, like Amazon has been to people and other people like that. But it can also be, you could be left holding a very expensive bag if things turn. Let's take a look here. You've almost doubled, well, you're more than doubled the stock since last March. So you went from 21 up to 54. This is a $61 billion company. It's huge. And again, it's in the semiconductor industry. But again, you know, from my school of thought, I get a little bit concerned when you get too far away from the moving averages. Now we're at 54. And the 200-day you can see there is 38. Excuse me, 34.80. Let's round it up, give the break, 35. So that's going to be, no, let's call it about 19 bucks above the average, which would mean in terms of percentages, it's 54% above its 200-day moving average. Now you can see on this chart on the left, you know, I'm sure when it was up above 30, it was above the average, and it came back down here. If this thing really had a drop here, going back towards this 45 area would not be out of line, and that coincides with the 50-day moving average. So if you're in the stock, enjoy the run and monitor it. And if you see signs of exhaustion, which would be a high point surrounded by lower points, and you want to do some hedging tactics, such as covered call writing, put buying, or collar strategies, combining the covered call and the buying of the put, you know, that would be something to entertain once you get the feeling that we may have run its course, at least on the short run. But, you know, you can't fight the tape. This is a very strong market. And again, it made 52-week highs, I believe, today. So again, very strong sector, very strong stock. No weakness in sight. The volume today was huge, 72 million. It's been averaging 50 million, so that's almost 50% above the 50-day average on volume. So apparently people are really plowing into this company in a big way. So again, a little bit extended if you're starting to just buy in, obviously, and also maybe early to sell because there's no real no signal that it's been exhausted. You know, just because it's 55% above its 200-day average is not alone the reason that you would think it might come back. You'd want to combine that with some technical picture. Again, a weekly, a daily, a monthly graph that shows a high point surrounded by lower points, which is one of the ways you kind of look for an exhaustion. All right, so that's AMD. Very big sector semis and a very big winner, AMD. Roku. Okay, on Roku, 137, another big day here for this guy. Broke out from that little downward trend it was in, and broke out today pretty big. Volume was 19 million shares. Let's see exactly how that works out. This is a company that has really been back and forth, back and forth. Let's put the screen up here so you can see it. And then let's talk about it. Again, this is a stock that was way above its moving average when it was at 180. And the moving averages were down in this 100 area, right? And look, for whatever reason, it comes back down to the average, holds it, and now it's been a buy since. Now it got way above the average again, probably, you know, when you're down here, comes back down towards the average at 120, and now it looks like it's on the bicycle again. That looks like a breakaway situation. Again, getting above 150 and trying to fill that gap would be the next logical place that I would think it could go if it can take out today's highs. Again, 142.45, it did reverse off of there quite a bit. So what would I say? I'd say if it pulls back and fills the gap and holds 135, that would be a good thing for the bulls. And of course, if it gets going above the high of today, 142.45, taking a shot at 153 to 160 might be in the cards because of the fact that there's a gap there. Let's go to a shorter term graph so you can get a better look at that. I've got a 1-year graph up there. Let's go 6 months and see if we can see something that way. A little clearer. Sometimes you change the time frame to give you a little clearer view. Okay, so there's your clearer view. A run at 160, if we can take out today's high, not off the table at all. And again, if it does pull back, you certainly wouldn't want it taken out 130, and you'd like it to hold the lows of today, which is 134. So holding 134 area, very good. Taking out 142, very good. Breaking under 130, 125, very bad. Other than that, it does look like it's trying to go someplace. And let's look behind the curtain and see what these numbers look like. Again, short interest is quite high on this stock, right? So what does that mean? Let's go back down and give you a good view. Okay, so right now you can see that it's got short interest of 14.85. So there's plenty of people short this stock. The company's still losing money, according to what I'm seeing on the 52-week EPS. Again, this is a technology type situation with audio video equipment, and obviously it's betting on the future of this company. Competition is starting to come into this area, though, so that makes it rough. And so you got to be careful. Longer term traders, you certainly wouldn't want it under 100 on any stretch. And short-term traders, obviously we went through some numbers already. The volume was 19 million. It is higher than normal. So it came up kind of like AMD on good, strong volume today. Sometimes after a big move up on strong volume, it can pull back a little bit on light volume. So be careful of that. But the moving averages are inverted to the upside, 133 and 120. That's a positive. The market today, when it hit 142, was 22 bucks above its 200-day moving average, which you see right there is 120. And so basically, what are you looking at there? You're looking at 18% above its 200-day average, which is moderately overbought. Again, 30, 50, 100% is more significantly overbought. But certainly almost 20% is nothing to sneeze at either. So bottom line, a little bit extended, but it also could be in the verge of trying to break out. That today's high, if it gets taken out, would be a very constructive thing. Okay, so there you go with Roku. And again, the last two stocks certainly had good days today. But if I'm doing short-term trading, in my opinion, my observation, I'd like to probably re-engage when we break 142 and see if it's going to 150 or 160, then trying to buy a pullback, because if it starts pulling back too much here, maybe it was just a little bit of a one-day wonder today. So we have to be careful, because something that pops up to 143 almost and then comes home at 137, there might be a reason for that, and we might find out that reason in the next few days. All right, next one up is Microsoft. This is the one that just keeps going and going and going. They got a jump start on everybody on the cloud business. The cloud business is very profitable, and that's the whole story, I think, as far as why this thing keeps going and going and going. Now, it did go up to 190 today, and it went home at 144. So was 190 the blow-off exhaustion? You got a 32-to-1 PE ratio, so people are really paying for the future here. And when you pay for the future, that's great up to a point, and then sometimes it can bite you in the you-know-where. So let's find out. And this was I think it was an all-time high and then go home down. So a little bit of a reversal. And look at that volume, 52 million. We will get into that in a minute, where you can actually see what the volume compares to. But this is a company, as you can see, that's gone from it's almost doubled in the last 52 weeks from the low to the high, and this is a very big company. So that's a lot of buying power. Again, most of these indexes, be it on the NASDAQ or the S&P, has Microsoft in it. In fact, they have 5 of these companies in almost every one. The 5 companies are what? Apple, Amazon, Microsoft, right? Facebook, and Google, right? So you take those 5 companies out of these indexes, and believe me, they're nowhere near where they're at. So if there's a crack in the armor with these 5 companies, that's when you'll get your correction, because they dominate these indexes. And of course, passive investing is very big. So as long as everybody goes to their mailbox and the month before shows you you have a higher balance than the month before, what me worry is the philosophy. And so until you start seeing month over month negative statements, getting these passive investors to sell out may be difficult. At any rate, those 5 companies are very good to keep an eye on, because again, they do have heavy weighting, predominant weighting in some indexes. Okay. All right. Now let's go behind the curtain, see what's going on with Microsoft. Okay. Look at the volume today, and let's see what that may. Let's see how that works out. Let's bring this down so you can see it. 1, 2 seconds. Okay. So let's try one last time here and stop it. There you go. Hey, 184 down 426. The volume 52 million. That's double normal. Now you blew off and made a high and then closed lower on double volume. I'll be watching this company very closely because that 190 mark might be something of significance. It actually is one calendar year from the low. Look, February 12th was the low last year at 105. February 11th this year, 190. So you've had almost a double in it one calendar year. And this company is, again, just like Apple, this monster, almost 1.5 trillion market cap. That's ridiculous, large. And again, the P ratio 32, so they're not giving the stock away by any means. Now, where are you at on the averages? They're inverted to the upside, which is quite good. And then you have got a differential today when we hit 190 and the 200-day moving average at 142. You had a differential of 48 bucks. What does that mean in terms of dollars? It's 25% above its 200-day moving average on a $1.5 trillion company almost. That's significant. And so again, this 190 level we saw today, let's monitor that. The longer it stays underneath today's high, I think the more that it's possible that you're going to see something that gravitates a little bit back towards these moving averages, 160 or so on the 50-day, 142 or so on the 200-day. So let's see what happens. But that's a huge volume with a very volatile day, up to 190 and going home at 184 and change. Okay, so keep an eye on that, and let's see. And it opened at 190. So not only it opened high, went a nickel higher than the opening, and basically people were selling it all day long, bringing it down to 184. So keep an eye on that 190 as a possible line in the sand. And again, if you wanted to do some hedging tactics using that 190 as a key point, you could consider the covered call writing or the put buying or the collar strategy, the combining of the covered call and the put. If you don't understand these strategies, simply talk to your broker, or I'm more than willing, and we're more than willing to answer questions on these, again, about the use and the risk of the tactics. And you can reach us at optionprofessor@gmail.com. And if you had a question on any of this stuff, you'd simply shoot me an email. We'd try to give you a hand on explaining, the strategy. Whether or not it's right for you, that's something you as a suitability person and your brokerage firm will determine. But the mechanics of how the strategy works, certainly I could give you clarity on that. With regards to the next stock here, is Boeing. And I was looking at this as well today because I think it's kind of interesting. That 300 number on Boeing really is your line in the sand. So you know exactly where it has to stay above if you want to stay bullish on this company. Now, let's take a look here because, this company has got a two-horse race, right? These guys and Airbus. So right off the bat, you got a good situation on a competitive situation. But people are now talking about in the years ahead, will there be as much demand for these planes from the standpoint of if the economy slow down? You've got Italy and you've got France with negative GDPs. You've got Spain and you've got Germany with barely growing GDPs. And I think England came out and said they're flat as a pancake too. So you don't have robust growth going on anywhere. And then if you look at your emerging markets and your Asian companies, they've been stalled out pretty good here this year. So it's a situation where you've got to figure out, is the demand for these planes going to be there? But this thing sold off to 300, as you can see. And that 302 I think is a key number. It blew out all these low points. So obviously sometimes after they blow out the lows and all the people get stopped out or sell their stock out, the guy down there who's taking in all the volume, he can see that the volume's drying up. And the next thing you know, all the people that are short and spec buyers come in and value buyers, and they believe like they're getting a good deal. Okay. But they've got nothing but problems as far as their cash flow. They're issuing bonds and all types of situations that didn't normally have. They used to have huge free cash flow. I think that's changed quite a bit. So again, if you're a longer term holder, it looks like 300 is not a bad line in the sand to grit your teeth to. And if you're looking for upside, let's take a look at value today was 5 million. Let's take a look at the detailed graph here and see if it tells us anything that we can use. All right. On Boeing, here you go. Again, it also had about 300 low at the beginning of January, or when the market was going down big time at the end of 2018. That 300 area ballpark also held up. So that's why that neighborhood is something of, better hold up. And then 350 could also be problematic here because that's some lows in here. So 350 might be a rough racket. Getting above 350 would be very, very constructive. Getting above 400 would get you into open area. Now, volume today, 5 million, light, about average for the 200-day average, right? 5 million. But in the last 50 days, it's lighter volume because it used to be around 7 million shares traded. The moving averages are above the market and pointing down. You want the good news is you're above the what? 50-day moving average, which is 326. Bad news is you're below the 350 number. And as I said, that could be problematic because there's, as you can see my cursor showing you low points and somewhere low points here. So 350 could be a rough racket to get through because why? You got the 200-day moving average and you've got some technical resistance. So that's pretty much what I would say. Dividend yield is 239, nothing fabulous, but not terrible. And again, one of the reasons you'd hold on to it is that it's in a business where it's a two-horse race, and you do believe their problems will get resolved, and you do believe the planes will be sold and put back in the sky. That's a lot of believing, but if that's what you believe, that's the story on Boeing. You certainly are buying it at a discounted price to where it has been, but if it blows out 285 and 300, then that's changing the dynamic quite a bit. All right, let's see what else we've got here. Next one is going to be Bristol-Myers, which I have been following a little bit, and I do think it's in a very good sector. Sector is healthcare, and so it has been doing well because healthcare is doing well, generally speaking. Okay, let's move this thing down so you can see it and give it a good view here. Ay, caramba. Okay, there you go. All right, so what are we looking at here? We're looking at 66, 67 bucks. You can see in the last 52 weeks, it's gone up about 50% from 42 to 68, a little bit better. Bottomed out here at around that 42 number in the summertime. And then it started to go up in the fourth quarter, and then of course it accelerated as we hit the December timeframe. So it's been steady as she goes, and again, it's a company that they've been announcing good reports, and they did a very large purchase, which might be starting to pay out for them. And it's a pharma company, and we all know that the baby boomers are in their medical needs years, and so pharma and biotech in that is really caught a bid. Okay, so where are you here on volume? Very light today, 7 million shares, and normal is 14. So the volume's drying up as the prices are up. So I would say that you got to watch this thing pretty close. And also it's getting a bit extended from its 200-day average. Where's the 200-day average? 52. Where's it trading? 67. So in terms of percentages, it is trading 28% above its 200-day average. You know, the market, when they say the market's overbought, this is the kind of stuff they're talking about. That doesn't mean it has to roll over. It just means that on an odds basis, on a probability basis, the longer these things get further away from their moving averages, they're not getting less overbought. So that's why, you know, people try to get some parameters on valuation through PE ratio and price to book and all the rest, and something technically on where it is versus the mean, which is the moving averages. Okay, so I would say on this company, it is overbought. I think the volume drying up here is somewhat nerve-wracking. I think the 70 number you can see was the former highs up here in 2019. So there's a whole confluence of reasons to be careful up here because, again, it's running into some former highs. It is almost 30% above its 200-day average, and the volume today is starting to dry up. So I'd be a little bit careful of this and a little bit cognizant. Now let's look at a shorter term graph that could maybe give you a price point. That reaction it just had down in the last 3 months. Let's take a look at 3 months and give you an idea on that. Okay, so you can see this point here. Caramba, hold on 1 second. Yeah, this point here that you can see at 62, That would be a very good line in the sand because it held all the way across. So again, you can see 68 has been the high point again. And again, if it stops here at 68 and then comes down, boom, be careful as it breaks under 62. Again, the moving average, I believe, is in the 40s. So, it's got real estate. It's got room to move. I don't think it's in the 40s. It could be in the low 50s. Let's double check that real quick. Yeah, 52. So it's in the low 50s. It's trading in the high 60s. So there's room. There's room if it wanted to have a correction. And if it breaks under 62, I think it probably will have a correction. So those are some numbers that I would look at if I was into this. It is paying a yield of 269 according to my screen, which is not too shabby. And it's in a sector that has been very, very active. So keep an eye on it. And again, with the moving averages inverted, moving to the upside, the sector being fairly good. Any significant pullbacks might be a buying opportunity. 62 and 52 are not bad numbers to use as a reference point. Okay, Pfizer. Well, basically another pharma deal, and this one has not had the legs of the others for whatever reason. Their pipeline or their stocks are coming off of patent or whatever. But again, this company here has hardly made the move of the other. It's gone from 34 to 44 from the low to the high, and right now it's smack in the middle, as you can see. Technically, it went up and filled this gap. You see when we're down here and the gap's up here, you might say to yourself, as long as this stays above 34, I think it's going to go fill that gap. Well, that statement was very wise. Would have taken you 6 months to do it, but $6 on $34 is almost 12, or $7 on 34 is 20%. Not bad. A 6-month return of 20%, and you got paid $3.99 to see it happen. So, looking backward here, you had the big break down to 34. It held. Then it started to move above it. So if you took a shot at it down here, you hold on to it, you collect your premium, your yield, and then as long as it matriculates up and doesn't take out 34, you're betting that it's going to fill the gap, and that bet paid off. Now let's take a look behind the screen and see what's going on. Now this thing traded 15 million shares today, so let's see what that's all about. Okay, it has traded 15 million. The average volume is 20 million. So it's light, just like the other one, light. And again, you can see why it stopped at 40 area, right? You see all those lows, that's called resistance. You see that move right there? That's called the resistance. So where would I like to see this trade if I wanted to really be interested in it? I'd like it to clear out these recent highs, the 52-week high, the yearly high. So whatever the year-to-date high is, I'd like it to make a new year-to-date high so that I could get in with some momentum. Right now, everything's right here. Your 200-day average is 38 and change. Your 50-day average, 38 and change. So if we can hold this neighborhood here, that's not a bad sign. And if it broke above the yearly high, I'd probably consider it a buy with a stop underneath what? The 38 numbers, and see if you can get a play out of it. And that's not a bad thing to consider. So again, right now it's the show me state. Can you get above the yearly high, which is 40 and change? And then if it can, you jump on the train because it'd be blowing out these resistance here. And then you obviously want a line in the sand. So the 50-day and the 200-day right around 38 doesn't look like a bad line in the sand. Right around there. Okay, so those are the two farmer ones. And here at 35, I'm going to take just a little bit of a break off the list here and show you a couple of ones that I have been keeping an eye on. One is in the area of pharmaceuticals, again, drugs, and that's Teva. And it's had a big run, but, this is the last year. You can see, well, if you go back further, you can see this stock came down ultimately from in the last 3 or 4 years from 70 all the way down to 6. Right? And now it seems to be going back up. I don't know if it's just going up to fill that gap and it's going to die there at 14. It's possible, but it does seem like it's more constructive than it has been. And certainly once it got above this resistance at 10, it's popped here to 12, 12 and a half pretty fast. So, if this company is going to come back, the recovery, the moving averages are in the 9s. So it's trading above the moving averages. It's extended again right now, but again, it's something that on a longer term basis might be worth monitoring. General Motors is another one that some people have always loved, but it's been, dead money for such a long time. It's going plus and minus 35 for the last how many years. But now it does seem like it's trying to make a move, and the dividend right there is certainly nothing to sneeze at. Now, if it can get above 35 here and 38, this area here, that's where its moving averages are. So getting above this area would open up the door. Things that I've been looking at that you might consider is, I don't know if anybody's priced out mortgages, but refining your mortgage is a significant savings on your monthly payment. So things that are financed, like leases, are interesting right now. Companies that do a lot of financing, like Square, seem to have been getting a bid, as you can see. There's Square. Again, they may be extended here and they may be due for pullbacks, but if the interest rates are to stay low and financing is going to be popular, sometimes these are the companies that benefit. The other, Lennar Homes, obviously, to buy a home is getting very cheap again as far as the monthly payment. And so you can see Lennar Homes has been the place to be as far as growth, but I'm sure that's very extended now as well. But, again, pullbacks during bull markets are sometimes reasonable to take a look at. And two areas for pullback would be right around this 65 number, if you got down there, and then, of course, a little bit above 60 or right around 60. So 65 and 60 would be two areas to consider, as long as the fundamentals of low interest rates stays the same. Another one that seems to have caught a bid on that home thing is KB Homes. And so, again, similar, had a big run up, and it continues to look pretty good. Again, these companies are going to take advantage of low interest rates and low mortgage rates, right? And so that's just something I saw. Healthcare, biotech, that kind of stuff seems to have been doing good. The building suppliers and the home builders seem to be doing good. The ones that the bloom's coming off the rose a little bit has been some of the banks, because if you drop interest rates and cut out their margin, it does reduce them a little bit. But see, after that drop in Bank of America, it's back on the bicycle as well. But now it's going to be in a decision time. If we can take out 36, you're off to the races, and interest rates probably are not going to go and stay low. If in fact they are going to go and stay low, then this thing could obviously also fail up here and revisit downward. So again, the banks are very key with interest rates, because they loan and borrow, and if that differential is wide enough, there's a lot of profit for them. But if the differential converges, then of course that's not the case. A good example is Deutsche Bank. If you look at the last 5 or 8 years or whatever of negative interest rates in Europe, the stock has had a lot of trouble, albeit it has turned now, because people are thinking that these PMI numbers in Germany are turning and Europe are turning, and that Deutsche Bank may actually be able to pick up their steam, just to give you an idea. Let's take a look real quick. That's at 1050, and as you can notice that this is a little bit of a bet that the company is not going to go out of business like some people speculate, and that the PMI numbers are going to stabilize and move higher in Europe, and these guys are going to be able to benefit from that. Let's take a look at your moving averages on Deutsche Bank and look at those. Yeah, and there they are. See, $8 and $7.60. So once it cleared $7.60 and once it cleared 8, that was your buy signal, and now that's your line in the sand. So any pullbacks using these two numbers as a get out point or a line in the sand, might make some sense, because again, if these guys are correct, or people that are speculating on this, that the PMI numbers are stabilizing and Europe is going to turn around, there could be some reason why this bank might do more business. Okay, so let's jump back to the list here. There's many other ones that I look at from time to time. So if you have any interest in what I'm looking at, optionprofessor@gmail.com, and we can kind of communicate our opinions and our observations. This is Salesforce, I believe. No, it's not. Hold on. This next one, let's see. CRWD. CRWD, CrowdStrike, right? Yeah, CrowdStrike. Okay. Again, this company's been all over the place. Let's take a look here and see what's going on. All right. Well, obviously it came out this year and then boom, went up to 100, tanked all the way down, lost about 60% of its value, which is kind of a Fibonacci number. And then it has stabilized at that 44 or 45. So there's your line in the sand. Anything you're doing, you certainly don't want 45 getting taken out. And then as far as return to optimism, yeah, there does seem to be something going on here. And if you can get above 70, puts 80 in the mark. 80 could be tough because there's that gap there, and then that's where it broke from. So 80 would be a target that could have some trouble getting through. Again, today it had a good day, up almost 3%. And let's look at the moving averages and see if there's enough data there to actually use them. And the moving averages are still very inverted to the downside, but it has cleared the 50-day and it has cleared the 200-day with today's action. Now the question is, can it hold it? Because if it can't hold it, it's going to obviously have another rendezvous with a correction. Again, 45 and 55 are the two key numbers, 45 being the low it's hit during the drop and 55 being the 50-day moving average. So if it does pull back, look at 54 and 44 as two key numbers to trade off against possibly. And then again, the longer it can stay above 65, the better, so we can get these moving averages turning up. Today's volume was very big, almost 8 million shares. And look, it's only been averaging 5.5. So boom, and it's double what it was over the last 200 days. So interest is coming back into this thing, and it's a software company with a lot of short interest, 19%, and it does look like it's losing money. So it is something you're betting on the future, and when you're betting on the future, obviously you have to pay up for that. And when you're betting on the future, if it comes in, you could have a nice silver dollar in your hand, and if it doesn't come in, you could have a rusted kettle. So bottom line is if you're a believer in this company and their technology, then obviously it might be worth a bite with your stop out points anywhere 54, 44. And then if you just think it's too volatile for you, look elsewhere. All right, next one up is going to be Lulu Lemon. And this one is a very big favorite for people that are looking for growth because it's been delivering growth, and just look at it. Okay, now you can see that the, one more time here, get back into play. Okay. Okay, there you go. Again, the stock is up near its all-time high. And so it's a rough racket to jump on anything that just doesn't seem to pull back. You got very little pullback here, right? You had a pop back up and then never took out that pop. So that was a good sign at 165. Came back up to 195, pulled back, never took out 165. Once it took out that former high of 195, that was a good place to keep going. Took out 210, never took out 210. Then it took out 240, okay? Took out 240 a little bit, actually 235, never really took that out. So right now, the thing's on the next run. The same, I would say 240 underneath there wouldn't be very good. And of course, whatever that number is, 235 or 230. So you're looking at a situation right now where, again, let's take a look at the internals. Had a big day today, but I mean, this company has really gone on a run. It is trading $50 above its 200-day moving average. So 50 divided into 200 means it is 25% over its 200-day moving average. A little bit extended, right? But again, you can't fight the tape, and the tape has shown you nothing to tell you that it's going to roll over. So again, using the weekly lows or something like that might be one way of trying to track this thing. It's got very little short interest. And today's volume was very light, 1 million shares, and it normally trades almost 2 million. So again, the volume's getting skinny up here. The prices are high, and they're extended. That seems to me not the greatest time to start putting new money to work. it might be time to consider, when you see something that you feel is indicating exhaustion, to consider your covered call writing, to consider your collar strategy, to consider your married puts. Again, if you don't understand really how that all works, optionprofessor@gmail.com, you could shoot an email over and we could try to give you an explanation. Okay, so that's Lulu, and again, great company, very strong, but very extended to a degree, and also the volume seems to be drying up just a bit. All right, we got 5 more I got to get through here, so let's go one at a time. Amazon. This one was dead for a long time. Then they had that earnings report, and then it took off like a bat out of you-know-where. So let's see what that means. Today, it looks like a reversal of sight, right? You went up to 2185, and you went home at 2150. Volume was 5 million shares. This is a very expensive stock, so 5 million shares, that's a lot of money. 6 million shares, that's a lot of money. The PE ratio is getting rich again. You know, one thing about this company, I thought, why it was down was because of the valuation. We were way over 100 PE ratio for a while when we were up at this 2000 area, right? And then the 200-day moving average was way down at 1550. So why did we have these pullbacks down after it went up towards this 2050 area? My belief was obviously the valuation. People did not want to pay that much for $1 of earnings. And 2 was that the technical picture was too far away from the moving averages, and they wanted to converge that. That's exactly what happened. After they did that, because they didn't have too many robust quarters of earnings that people liked, the market went sideways. But when they announced they had 150 million paying customers on Prime, that's why you took off like you know what. Now, the web services, Amazon Web Services, again, that's a big moneymaker for them, but there's a lot of competition running into there. In fact, you might even see IBM jumping in there because of Red Hat and because of what? Because of this new gentleman who was involved in cloud computing, and now he's the CEO. So you could have more players in here. More players sometimes crunches margins, and if you crunch margins on one of your big money makers, that can have an effect. But clearly, a big volume breakout, and you may see a lower volume pullback, and that's a big gap. I don't know if that's going to get filled. A lot of them get filled over time. So between 1900 and 2000, there's a big gap sitting there, and we'll have to see over time if it's going to get filled. Now, let's take a look at and sometimes it pulls back to the breakout point. So the breakout point was 2000, 2050. Pulling back to that area, it seems very reasonable. So, and again, the moving averages are still inverted, but they're about ready to cross. 1824 is the 50-day, and 200-day is at 1829. So very close to crossing. And that's probably not a bad line in the sand if you wanted to be long this company with some kind of a parameter to stay above. The 52-week low is almost 1,600. I don't think you want it anywhere near that number. So again, the 2,000 mark area, that would be the 2 former highs, right? 3 former highs. So that could form support on a pullback if you're a bull. And then, of course, underneath that would be your moving averages in the 1,800 neighborhood. And then underneath that is your 1,600 neighborhood for your 52-week low. So you got some lines in the sands to work against. Volume today, almost 6 million, is much higher than normal. So obviously, was this a high volume blow off reversal on a Tuesday, turnaround Tuesday? It could be. Let's monitor it. We see some of these stocks had highs today. Microsoft, Amazon. Let's see if they can't take them out over the next week or two. And if they can't, it'll be interesting to see if some of these things come back and fill in the differential between the 200-day average and where they're trading. Okay, so that's Amazon. What's the next game in town here? And that is going to be something that people probably are not very happy with, which is Exxonmobil. Now, why don't we take a look at crude oil, since they're in that business, and see what it looks like real quick. And that'll give you an idea of what the underlying commodity looks like. Yeah, my feeling on this crude oil was that Aramco was coming out with that $2.5 trillion offering And they weren't going to try to sell that stock into a down market like we have now. They wanted people to buy it, and $2.5 trillion is a lot of money. So they, I thought, and their compadres in OPEC engineered some kind of a run-up in oil, which took you from 50 up to 66. And then they got rid of all that stock they wanted to at $2.5 trillion. After that's all done, look what happens to the prices. Is that coincidental? I don't think so. So the bottom line is my opinion is that they, whatever they were doing to support prices, they stepped back, and it fell under its own weight because the supplies of crude oil is all over the place. There's stuff in storage. There's stuff coming out of the Texas area with the shale everywhere and this and that. So bottom line is that what's the story here? 50 was the story. And right now 50 is the story. So if you're a speculator and you're thinking about taking a shot, you know, the low has been 49.31. You know, is this going to hold up? Well, only time will tell. But certainly it has been sold off. And if it breaks under this level, you know, obviously it's going to open up 40. I had heard that Russia is happy with oil as long as it's above 40. So that's a key number for Russia. And the likelihood of them cutting production is pretty low until it breaks under 40, which means that the Saudis are going to have to cut back their production if they're going to tighten the supplies. Since they just banked $2.5 trillion of money, maybe they can afford to cut back supplies, right? Okay, so anyway, that's the story on crude. Now let's take a look at the story on Exxon. We are going into the summer driving season, so there's some demand coming up. I mean, not going in tomorrow, but in the months ahead, that's the next thing that could cause a pop in the price of oil. Again, the demand from the summer driving season, or just the whatever you call it with the price, fooling around with the price to make it go up while people really need it. Okay, Exxon, not a good story. In the last year, you've gone from 83 down to 60. I'm sure that low was made recently, very similar to the crude price. If you're a believer that the 50 is going to hold in crude, then you'd probably be a believer that the 60 is going to hold in Exxon. It pays a good dividend, but I've noticed that companies that have paid good dividends, the stock has gone nowhere or lousy, and that's why the dividends are so high. Sometimes you look at the dividends aristocrats, and those are guys that you know, increase dividends all the time. They're some of the worst performing stocks. Okay, so anyway, best performing stocks. That's why their dividends are low, yields are low. All right, Exxonmobil, again, downtrend. You know, is it going to hold 60? You know, maybe, maybe not. Again, big volume drop and maybe a light volume pop. Lots of resistance here underneath 70. Be very difficult to get underneath there, above there. So again, it looks like you're going to collect a dividend and hope that the stock doesn't break 60. Okay, let's go through the last three real quick. Viacom. I like Viacom because the valuation is very low, and the stock is very low. Again, it has a pretty good dividend because of you know, again, the stock's done nothing. But again, if you want to take a shot down here, there's your line in the sand, $32, right? And if it gets above 35, it could start accelerating on a 1, 2, 3 formation. 1 up, 2 back, and then 3. Plenty of resistance right here above, more resistance up around 40. Look at that P ratio. This thing is going to be good when they figure out how to take all that content they have and monetize it. And again, with all the streaming going on, monetizing your inventory is key, and that's going to be the key to Viacom. Again, is it worth a shot down here? You know, maybe, maybe not. Put it on a short leash. If it gets above 35, 37, probably be looking pretty good at that point. And again, Tom, Dick, and Harry are probably short or out. So obviously, if Tom, Dick, and Harry are short or out, it creates some buying in case it does start turning. But again, it's a gamble, no doubt about it. Okay, next one is going to be IBM. This is one I really like because of the fact of the change at the top. But again, I'm not the only guy. The stock has gone up very, very sharply. So what do you do with IBM? Again, once you broke above 140, that was your time to get in, right? Breaking above 140, breaking above 145, another day you had to get in. Now it went up towards 160 and it's pulling back. If this guy is going to make them competitive in the cloud business or in what they call edge computing, which is supposedly the next thing in town, then this company has quite a bit of a future. And that yield of 422 is a heck of a yield to watch a movie that could be a very exciting movie in the years ahead. So again, if you're a believer, Yeah, anywhere between 145 and 150 might not be a bad place to see if you can get in and then get paid while you're doing it. And as long as they don't cut the dividend, see what you can do there. But this could be a very exciting company because the guy who took over is very savvy in the things that are making people money now. Last but not least is Light. Okay, Light is Lumentum Holdings, and they're at 91. They're doing quite well. And what is their business? Networking. So again, probably something in the area of the semiconductor area or networking, maybe like Cisco Systems or something. Obviously, it's on the bicycle here, but it is getting very overbought. It's 33% above its 200-day average, and 33% is hardly a great time to get in there unless you're just speculating and you just think the momentum, you want to ride the wave. 75 is a key number, which is your 50-day moving average, and then 60. Okay. All right, guys, we're at the top of the hour here. I did want to thank everybody for being here. And again, we got through the whole list, so God bless us. And there's many other things we could talk about. If you have any comments for me, I'm Jim Kenney. And if you have any questions for me, shoot it over to optionprofessor@gmail.com. Right now, I'm signing off. I'm going to hand it back over to David Kosmider. And again, thanks everybody for being here. If you have any questions, shoot me an email.
All right, thanks, Jim. Lots of good info today. So just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube or your favorite podcast directory. And you can also go to TimingResearch.com to get access to the recording of this or any of the past shows. And so I just want to thank my guests again for today, Jim Kenney of OptionProfessor.com. Be sure to check out his site for his weekly market updates. So, all right. Thanks, everyone.
Thank you.